Hi everyone! Today I will show you a real trade example with LYFT and explain the strategy I call stacking. It's a way to lock in profit from stocks while keeping the upside potential to multiply your returns with minimal risk. No theory, just real numbers and live setup and logic behind it. I bought 200 shares of LYFT at 16.14. Now the price is in around $22. So I have approximately $1,200 profit. I want to lock in that profit but still stay in the game for a potential rally, because I believe that there will be a rally. So I plan to sell the shares and buy 2 call options with 22 strike and expiring in January 2007. Each call cost in around $620, so I spent $1,240 in total, about the same as my current profit. Let's take a look at this in option strat. Here I sold 200 shares that I bought at 16.40 and I bought them and I sold them at 21.99, and I bought 22 calls for 620 each. As you can see, my break-even point is at $22.44. If we go up to, I don't know, $50, my profit will be $5,500. And at the same time, if the price will drop, I don't know, to $2, my risk will be $85. So approximately there is no risk in it. Why am I doing this at all? I originally invested $3,200 into those 200 shares. That is my risk capital, the amount I can comfortably risk per trade. By selling the shares, I free up that $3,200 in cash. From my profit, I spent $1,200 to buy calls to keep exposure to upside. And now I still have $3,200 cash that I can reuse if the market pulls back. If LYFT drops to $18, I will buy 8 call contracts with a $20 strike at 4 each. That's another $3,200 position, the same money I had in shares before. Now let's add the second layer in option strat. So here I will add 8 calls that I will buy for approximately $4. We will include, and as you can see, my total risk is $3,254. But if you go, for instance, to $30, my profit will be $12,000. If we will go to 50, my profit will be $26,500. The maximum loss is just 3% of my total portfolio, so it's either minus 3% or plus 26,000, depending on how far the rally goes. That's the essence of call stacking, turning locked-in profit into leveraged upside. Here is the logic. I take profit from stocks and use that same money to buy calls with limited risk. If the market drops, I lose little. If it rallies, profits multiply. In practice, this creates a layered option pyramid, where each layer adds profit potential while total risk stays fixed and predictable. Now let's take a look at LYFT fundamentals. EPS is growing, and the revenue also is growing, so we can see that It is growing with 80-100% year to year. In quarterly, we have also the year to year huge amounts. The forward PE is 15.3, very low for that kind of growth. The company used to issue new shares, but since February 2025, they mostly stopped. This means dilution pressure is gone, and it is a strong fundamental reversal. Technically, LYFT has already broken the high of the wave 1 and seems to be in the wave 4. So we can see here, you see two bullish candles, and then we have a gap, and all this with a high volume. That's a bullish signal. The next move is likely the fifth wave, with potential targets between 50 and 70. So both technicals and fundamentals are pointing in the same direction, higher. I sold 200 LYFT shares at 22, bought 222 calls for 620 each. Risk is $85, profit potential 5,500. If the price drops to 18, I will buy 8 more 20 calls for $4 each. Then my total risk is $3,200, but profit at 50 could reach $26,000. This is called stacking minimal risk, massive growth potential.